Welcome to OPCM's 2019 Investment Webinar Series. My name is Ben Viemeister, and I will be taking you through our 2019 Foreign Equity Outlook. After a tough year in 2018, it may be easy to forget that there are equities outside the United States. In fact, over 40% of the global equity market is outside the U.S., along with over 70% of the global economy and over 95% of the global population. Looking over the long term, having an allocation to foreign equities is prudent, as foreign equities have outperformed U.S. equities around half the time over the past 40 plus years, as the chart shows. Having exposure to foreign equities is especially important when two key factors that drive foreign returns, them being one, local earnings growth, and two, currency, could be set up to improve. We'll discuss why these factors could be set up to improve and give an example of a foreign market where we believe these key factors are set up well. Currency is a key driver of foreign equity returns. A U.S. investor's foreign equity return is made up of two things: the local foreign market return and the change in the local foreign market's currency. So, a strong U.S. dollar is usually a drag on a U.S. investor's foreign equity returns, while a weak U.S. dollar is usually a benefit for a U.S. investor's return in foreign equities. As the chart shows, in 2018, there was a rapid rise of the U.S. dollar, which was a drag on foreign equity returns. A few factors drove this U.S. dollar strength. One, a U.S. tax cut helped spark animal spirits and accelerate U.S. growth, driving U.S. demand for U.S. assets. Two, U.S. foreign policy disrupted growth for foreign markets and caused investors to seek the safety of U.S. assets. Three, interest rates in the U.S. rose faster than foreign markets, further incentivizing investors to purchase U.S. dollar-denominated assets. These factors behind the U.S. dollar appreciation could lose momentum in 2019, which could help foreign equities. Some of the forces that pushed U.S. economic activity versus the rest of the world to a multi-year high in 2018 could reverse in 2019. Regarding fiscal policy, the U.S. is unlikely to have another tax cut in 2019. In contrast, some key foreign markets like China are implementing fiscal stimulus. Further, some foreign markets are easing regulatory policy to improve business confidence and conditions, while in the U.S., a split Congress could lead to gridlock and make it tougher to ease business conditions. After the U.S. Federal Reserve raised interest rates 4 times in 2018, U.S. interest rates are close to neutral, leaving less room to increase before monetary conditions are considered restrictive. As a result, we've seen the Fed pause their interest rate hike cycle for now, removing a tailwind for the U.S. dollar. U.S. growth relative to foreign markets spiked in 2018, as the table shows. For example, in 2018, U.S. earnings growth outpaced emerging market growth by 13%, after trailing emerging markets by 12% in 2017. This is potentially set to shift in 2019 due to changes in key forces that we've talked about, like fiscal policy, monetary policy, and the U.S. dollar. For example, in 2019, consensus U.S. earnings growth is estimated to trail emerging markets by over 1%. Improved relative growth historically has provided a tailwind for foreign equity returns. When discussing tailwinds for foreign equities, it's not monolithic. There are unique situations that are particularly attractive, and we're going to talk about one of those right now. So an example of a region that could be set up well is Latin America. As the table shows, a relative growth acceleration versus the United States is expected by consensus in 2019. Factors that could support the growth pickup and also help Latin American currencies include: one, reforms implemented by new governments in Colombia, Mexico, and especially Brazil to improve deficits and economic competitiveness. Two, potential for the start of monetary easing in Mexico and a lagged benefit from record low interest rates in Brazil after a multi-year easing cycle. Three, continued recovery in Brazil from their worst ever recession. 4, All this is transpiring while the region trades at a significant discount to the United States and foreign investor sentiment remains cautious. Latin America captures a broader theme for foreign equity in 2019, the potential for relative growth and currency improvement versus the United States, which could support foreign equity returns and remind investors of the importance of maintaining exposure to foreign, not just U.S. equities. Thanks for taking the time to listen to our 2019 Foreign Equity Outlook. Please visit our other investment webinars covering our outlook for U.S. equities, fixed income, natural resources, and multi-asset class investing, which are all available on our website. Thank you.